Hello, everybody. My name is Mark. I am the stock market jobber, and today I want to just take a quick look here at Ford. But before we do that, I want to give you a little bit about my background because, unlike a lot of these Wall Street, teachers or trading gurus or whatever you want to call them, I got a lot of experience and I actually know what I'm talking about. So I was hired out of business school by Mario Gabelli, and I traded directly for him. It's one of the great money managers of all time. And then I traded directly for Steve Cohen, who's one of the greatest traders of all time. Then I spent 3 years. I was at three different institutional money managers as the head of trading, where I oversaw all the trading. So I've overseen the trading of various hedge fund strategies, mutual funds. I was a market maker for a while. So I want to talk about what institutional traders look at because I see a lot of stuff out there, um, which is just kind of, I don't know, anywhere from wrong to just ridiculous. And I'm talking about like these weird techniques, like people talk about Elliott wave and financial or Fibonacci. Like no one in the institutional world uses that stuff. What we do is we look at what price levels are important, what's the momentum, and what's the trend. Now, I would consider buying Ford if it gets down to around 1105. All right, it's at 1241 now, so it's still $1.40 away. But why would I buy Ford at 1105? Well, this is what we call support. It's a support level. Okay, when market's going lower, it's because there's not enough demand or buy orders to take in all of the supply or sell orders. When we get to a support level, the tide turns. All of a sudden, there is enough demand or buy orders to absorb all of the selling, so the market stops moving lower. And a lot of times these levels can stay intact for a while. And as we can see, we found support back in late September and early October. And once again in December, we found it at the same place. So this is called market memory. So there's a good chance that if Ford gets down to 1105, there's going to be some kind of a bounce because it's a well-defined support level. Now, one of the things I want you to notice is when we get to support, sometimes we get these big jumps, right? Like here and here. This happens because some of the investors who created the support with their buy orders, they start to get the sense that there are other buyers lurking around. That's why the stock's not going any lower or not going lower anymore. So they get anxious and they get afraid that they're going to miss out. So they start paying higher prices and it starts a snowball effect. Like someone might say, you know what? I want to buy this at 1105, but it's not going any lower. I get the sense there's other buyers coming into the market. I'm going to go up to 1110. Then the next person says 1115, 1120, so forth and so on. So there's a good chance that that happens here. Now up here we have what's the mirror opposite. This is a resistance level. And as we can see, this is right where Ford found resistance, the same level it found resistance here. So when a market is going higher, there's not enough supply or sell orders to fill all of the demand or buy orders. When we get to a resistance level, that changes. And now we have the same thing. The investors who created the resistance with their sell orders start to get the sense that there are other sellers around. So they start to undercut them. Someone might say, you know what? 1450 may not work. I'm going to go down to 1440. And the next person's like, oh, they went down to 1440. I'm going to go down to 1430. And we get a snowball reaction, right? So it's the opposite of bouncing off of support. We fail. The trader's term is we fail at resistance. Now I'm going to really amaze you that there's a reason why there's resistance at this 1450 level. And it's because it was the last level of support before we had this big sell-off. Levels that were support can turn into resistance, and this happens because of buyer's remorse. When we look at a chart, we got to understand that we're looking at a graphical illustration of psychology and supply and demand. That's why we don't at Stock Market Jobber. That's why we don't worry about those silly things like I just said, Gann theory, Fibonacci, because what do they tell us about supply and demand? Now there are people who bought here who regret doing so when the stock basically collapsed, and they tell themselves, I want to get out, but I'm only going to do so if I can get out at break even. So when the shares get back up to where they bought them, they place their sell orders at the same level they bought at. So if you have enough of these remorseful buyers placing sell orders at a level that was support, the level can convert from support into resistance, and that's what happened here. So please sign up for our YouTube page here, and remember we focus on simple things like levels, trends, momentum, and psychology. That's really the secret to being successful. All right, thank you, everybody. I hope to see you soon.